Nike will report results after the close today. To prepare, we're going to take a look at where consensus estimates stand relative to management's guidance given on the last call. And then after that, we're going to run some sensitivity analysis for what we think are the three most important aspects of today's call. First, the continued momentum from Category Offense initiative. Second, future FX pressure as U.S. interest rates rise and the U.S. dollar continues to strengthen against world currencies. And third, the North American inventory control efforts and what the impact could be on gross margin. If you'd like to download our free Nike earnings model, it's available on our website, gutenbergresearch.com. Click on the free models tab and you can download this one and all the other companies that we cover. And if you're new to our modeling approach, from our homepage, you can click here to download our overall modeling approach document, which goes through all the aspects of our financial models. With that, we can get started. So you can download management's guidance. It's in the last fiscal quarter's earnings call transcript. We've downloaded it into Word and highlighted the key guidance items. So starting with revenue, consensus estimates for this quarter, $7.8 billion, and management guided to a mid-single-digit growth rate. And you can see we've calculated the growth rate from the fiscal second quarter of last year, and the consensus estimate is implying a 5.7% growth rate. So of course that is in line with management's guidance, a little bit above the dead center mid growth rate, but still in line. For the full year outlook, management gave us mid-single-digit range, and here they said squarely within the mid-single-digit range. And if we scroll over to fiscal year 2016 full year, we are at 7.2% growth at the consensus estimate, so about 2 percentage points higher than management's estimate. So just keep that in mind for now. Then we go down to gross margin, and they expect second quarter gross margin to expand by 25 basis points. And we have calculated exactly 25 basis point gross margin here, expansion here. And for the full year, they expect the margin to expand by 50 basis points, which is exactly what we have in our earnings model. For SG&A, second quarter and full year expected to grow at a high single-digit growth rate. And you can see here we've calculated the SG&A growth rate at 7%, so that's high single digits, could be higher. And for the full year, we're at 7%, 7.1%. And then finally, they gave us guidance on the effective tax rate, which was approximately 22% for the full year and 24% for the next couple of quarters. And if we scroll down below our segment section, you can see our calculation of the effective tax rate. So we have 24% for the next couple of quarters and 22% for the full year. So overall, we are in line with management's guidance. And you can see that our EPS estimates, which are implied by that guidance, are in line with consensus estimates. Okay, now let's run some sensitivity analysis based on those three factors that we mentioned at the beginning of this video. So let's assume that demand momentum continues to increase as a result of category offense. So we're going to see the impact there in Europe and China. And let's just increase the growth rates for the next couple of quarters. Let's just stick with footwear because it's a bit easier to deal with. So instead of 25% growth in Western Europe, let's try 30%, 5% in the fourth quarter, and maybe 30% in the first quarter of next year. Central and Eastern, we'll do a similar type of scenario. So we'll go 29%, 34%, and we'll call this 10%. And then in Greater China, 25%, and we'll call it 1% and 10%. Okay, and at the same time, let's assume that the FX pressure, and again, this is our upside scenario, doesn't have any additional impact on top-line revenue. And for now, we'll leave North American inventory control as is. So you can see what happened to our share price. Prior to this, we were at 130. What were we at? If we undo those, 1, 2, 3, 4, 5. We're at 131.50, and we got up to 138 with all of those changes, 139 give or take. So you can see there's a good amount of upside here if management can continue to execute on their growth initiatives. Now let's undo those changes, and input a downside scenario. So we'll go back to where we were prior to the changes. Okay. And now let's say that the FX pressure has a bigger impact on results. So we're going to see that come through in the revenue for all the regions except for North America. So we'll just bring each of these down. Let's bring this to 20, -5, 20% growth. Call this 20%, 25%, 1. Greater China we'll leave as is. Japan 1, 42% growth, and 30%. And again, we're only changing footwear here, but you can go through and input your own estimates and change the other segments as well. Okay, so if FX has a significant impact on top line revenue just for footwear, you can see that share price could drop to 128. Feel free to download this model and input your own estimates into it and see where earnings and valuation shake out. And be sure to join us after the call when we update this model and input management's latest guidance. Thanks for watching.